Hello, everyone. Pat Smita here with your Tuesday, March the 25th daily interest rate update. We got a lot of news today, especially we got some home prices from Schiller, which is really the gold standard. And we saw that a year over year growth of real estate values from 4.5 to 4.7% annually. Now, we also got FHFA, which was month to month, and it's a little less reliable because it doesn't take into account all transactions, especially if they're not financed. And the growth decreased a little bit from 0.5% to 0.2% month over month. But still seeing some solid growth in real estate. There may be some markets that are slowing down, but we still see overall national growth. Now, we did see consumer confidence really fall again from a previous reading of 100 to a reading of 92.9. What's even more important is that we have future expectations that came in at 65.2. Now, on this reading, any reading below 80 is considered a recessionary indicator. So keep an eye on that because that's very important. Consumer confidence and consumer pricing counts for about 70% of the US economy. Finally, we saw the Philadelphia non-manufacturing index month over month, and it really fell from contraction of 13% to a contraction of 32%, and even a future outlook was even weaker. That's another recessionary sign because this is services in Philadelphia, which really accounts for a big portion of the economy and could be a national indicator. Now, for the rest of the week, we get a lot of news. Tomorrow, we get durable goods orders. Thursday, we get jobless claims and GDP, gross domestic product. This is how we measure growth in the economy in the U.S. And there's indications that it could be anywhere between a negative number to a very slow 0.2% growth number, which could really help with interest rates falling lower, and we get pending home sales. And then on Friday, we get personal income, the price consumer expenditure, which is the Fed's favorite measure of inflation, and also consumer sentiment, which is really important because we're getting different consumer sentiments, but they're all pointing to the fact that there's weaker uh, consumer sentiment out there, which accounts for a big chunk of the economy. So keep that in mind. You may see different indicators, but they're all pointing in the lower direction, which is lower. Now, finally, throughout the day, we did see that interest rates made a small recovery. Yesterday, we had a really bad day. Interest rates went higher, but we did get a small recovery coming back down. And this is mainly having to do with the fact, also in the 10-year bond yields, we saw the same thing where yields went higher, so interest rates went higher. What this is really being driven by is Germany authorized more spending on its military to the tune of about $600 billion. And what's happening right now is that that's being reflected in our inflation as well on the yields. So give us a call if you have any questions. We look forward to speaking with you.